Friday the 13th is considered to be an unlucky day by the more superstitious amongst us. However, the news so far today has been much better than expected. The US and China have reached a historic trade agreement that will see the next wave of tariffs averted and tariff rates on approximately $360 billion of goods imports into the US cut by 50% according to Wire reports. Now, it remains to be seen what the details are, but any agreement will likely include numerical targets which will risk the reimposition of tariffs if they're not met next year. So the risks of a fresh outbreak of trade wars is certainly very possible in 2020. However, global equity markets have responded well to the news, with the S&P making fresh highs for the year, up an incredible 26% year to date. Adding to this wave of optimism, in the Fed's last meeting of the year on Wednesday, Chair Powell repeated the very high bar for hikes, a significant and persistent move up in inflation, and downplayed the analogy of the 98 insurance cuts, citing structural differences in inflation as the key reason they won't be reversed as quickly. Powell also seemed to tip his hat to the dovish wing, citing several officials who've embraced an inflation overshoot as appropriate policy. Traders embraced the message that the Fed will keep rates steady until inflation really does pick up by marking commodity markets higher too. News that the Central Economic Work Conference gathering that ended in Beijing earlier this week saw top policymakers calling for contingency plans to offset growing global risks added to the sense of optimism about global reflation. Iron ore is up 9% so far this month, crude up 7.4%, and nickel has jumped 9% in the last 3 trading sessions. However, we would caution that significant risks do lie ahead for 2020. When markets return early next year, will be met by Trump's impeachment trial in the US Senate. While this is very much expected to leave President Trump in office, it will likely add to the sense of US political risks in 2020. Market attention will then quickly turn to who the Democrats will choose to run against Trump at the election November 3. There's still a remarkable 15 candidates competing for the Democratic Party nomination as the 3rd of February Iowa caucuses loom, though there are only a handful of candidates with substantial support in the polls. Key for markets will be whether the Democratic base opts for a candidate promising Obama-style center-left policies, such as Biden, Buttigieg, or Bloomberg, or a more aggressive shift to the left-leaning policies, such as Medicare for all, breaking up large corporations, substantial wealth taxes, and financial market transaction taxes via the likes of Sanders or Warren. US politics will likely act as a weight on the US dollar in 2020, and this is why Westpac is forecasting that the US dollar will lose altitude through 2020 and into 2021. While polls have only just closed in the UK, and we're recording this as just a handful of seats have been declared, exit polls suggest that the ruling Conservative Party will be returned with a significant majority, allowing them to get Brexit done. This has lifted the British pound to 19-month highs. The pound is the best performing G10 currency so far in December, but the Australian dollar has also benefited from this global optimism and rising commodity prices by jumping to a 5-month high above 69.30. However, we'd caution that interest rate differentials remain a key driver for the Aussie dollar, and Westpac is still forecasting that the RBA will cut rates in February and June of 2020. We're also expecting the likely adoption of quantitative easing by the RBA at the last rate cut in June next year too. That could come in the form of $2 to $3 billion of regular monthly purchases of Commonwealth government bonds by the Reserve Bank of Australia. Lower interest rates and open-ended quantitative easing can be expected to exert some downward pressure on the Australian dollar, and Westpac is still forecasting a 66 target for the Australian dollar for mid-next year. This is our last weekly markets update for 2019, and I'd like to take the opportunity to wish all our viewers and customers the very best for the holidays and 2020. It's been a difficult year for many in 2019, and we hope that this bout of optimism extends well into the next decade. We'll speak to you all again next year.